Hi, I'm Brad Rosley. Thanks for tuning in again today to Smart Money. My mission as a certified financial planner is to help you understand your financial decisions and make better decisions going forward. Thanks a lot for tuning in today. We're going to talk today about taxes, specifically itemized taxes versus taking the standard deduction. You may have heard of itemizing your deductions. You may have heard of the standard deduction. The rules changed with the 2017 tax law. I want to help you understand whether or not you should be itemizing or taking the standard deduction. Let me explain what it means. The standard deduction, start there, is a one-line item where we all get a deduction from our income that we have to pay tax on. Now, prior to the new tax law in 2017, if you were filing a single tax return, you could take a deduction of $6,000. That was called your standard deduction. If you're married filing jointly, it was $12,000. For many people, especially those that don't own a home, and I'll explain why in a minute, the standard deduction is what you took. The new tax law, enacted under President Trump, doubled those numbers. So for single people, rather than a $6,000 standard deduction, now you got $12,000. And for married filing jointly, $12,000 to $24,000. Most people, a huge percentage of people here in America, are taking that standard deduction, and they should be, which is now $24,000 for married couples filing jointly. Now, what muddies the waters is this thing called itemized deductions. Itemized deductions. Well, there are several things that fall under that itemized tag. And what you need to do is simply compare the total of your itemized deductions against the standard deduction, which we know, and whichever one is greater, that's the one you use. So let me explain what shows up in the itemized deductions. Number one is charity. If you make charitable contributions, you can use those as part of your total in your itemized deduction. That could be a church or a not-for-profit organization that qualifies. The second one is mortgage interest. Mortgage interest up to $750,000 loans. Okay? Mortgage interest plus charity, these are all going to be added. The next one that we're going to add to that is medical expenses. This is a tricky one. Medical over 7.5% AGI. Now that's tricky. Unfortunately, this is a high hurdle to qualify for. So in order to be able to use any of your medical expenses, this is not premiums, this is actual expenses. You take what's called your AGI, which stands for adjusted gross income. So if your adjusted gross income was $100,000 and you had $9,000 of medical, the first $7,500 you don't get to take, but you can take $1,500 of that $9,000 and use that as part of the equation to add into your itemized deductions. So far we've got charitable deductions, mortgage interest, and medical expenses over 7.5% of adjusted gross income. Now here's where everything changed also with the new tax law. The two other components of itemized deductions are state income tax paid, which, as you know, many states do have income tax, some don't. So that's not a factor in states like Florida or Texas or Washington. Some states have very high income taxes. The second thing is local or property taxes. Now, you used to be able to deduct all your state income tax and all of your property tax and add those into this equation, okay? So it used to be 4 and 5 were state and property tax. So in the past, you would add all these up, and whatever they added up to, you'd compare that with the lower standard deduction number. And for many people, they'd itemize because this number was greater than the $12,000 they were allowed in the standard deduction prior to the 2017 tax law. Now, the good news was that they raised that standard deduction amount from $12,000 to $24,000. However, they've capped this. They've capped the amount of money that you can use for state and property tax. They have capped this at $10,000. $10,000 is the total state income tax. Now, for example, in Illinois, where I happen to live, the state tax is just under 5%. So if we had someone with $100,000 of income and they were paying 5% state tax, well, that would be $5,000. And their property tax could easily be, we're the number 2 in the country for highest property taxes in the nation. The property tax could easily be $10,000. So under the old rules, we had a $15,000 that we could use towards our itemized deduction. So it'd be 15 plus, if we had any serious medical expenses, plus mortgage interest, plus charity. Okay? The new rule, we can no longer use 15, we can only use 10. It's capped. So this happens, it upset a lot of people in high state income tax and high property tax states. Okay? Now there were other things that offset this. Remember, the standard deduction now doubled. And one other major factor for higher income people is there was also a serious change to the alternative minimum tax laws, which I'll talk about another time. So a lot of people, even though they lost these deductions, came out ahead because of the change in the alternative minimum tax rule. So let's keep this simple. Look at your charitable contributions, add your mortgage interest if you had mortgage interest. Very few people qualify in this medical expense, but you might. And add $10,000 here for state and property tax. So you add these things up. So maybe you gave $1,000 to charity. Your mortgage interest was $3,000. I'm making this up, depends on your mortgage, of course. You didn't have any medical expenses, and your state and property tax were over $10,000, so you could only use 10. You add these up, let's see, in this case, $1,000 plus $3,000 plus $10,000, that's $14,000. If you are married filing jointly, that $14,000 is far less than the $24,000 standard deduction. So you're not even close to itemizing. Now, if you were single and you had these same expenses, you would have $14,000 of itemized deductions. You'd compare that to the $12,000, because that's the deduction you get if you're a single filer. In that case, you'd be better off using the standard deduction. For most people, if they don't have a home, they're not even going to be thinking about using the itemized deduction. Why? Because you have no mortgage expense and you have no property tax expense, obviously, if you don't own a home. So I hope this helps to clarify whether or not you should be itemizing or using the standard deduction. If you have questions about this, feel free to hit me up there with a reply on the video. I hope you'll watch my other videos, as I have a lot of different ones on tax planning and other investment planning. Don't forget to hit the red subscribe button. Thanks a lot for listening. Have a great day.